Hello, this is Andrew Thake from Minds and Money, and welcome to today's panel session, which is looking at actually looking at silver. After a year of underperformance in the silver price in 2021, I'm keen to discuss with our panelists what are the best opportunities over the next 12 months. And to join us to go and discuss these issues, I am joined by Angelos Damaskos, who's Chief Executive Officer of Sector Investment Managers, Ian Williams, Chairman and Chief Executive Officer of Charteris Treasury Portfolio Managers, and Professor Dr. Torsten Dennin, Chief Investment Officer and member of the Management Board of Asset Management Switzerland. A warm welcome to you today, gentlemen.
Thank you, Andrew.
Thank you.
Good. Let's going to start off with a question for Ian Williams. Ian, in your view, what's been driving silver prices in 2022?
Well, not a lot really, because it hasn't really been doing much. A lot of the attention's been on some of the other metals and some of the other commodities. If you have a sort of study of historic commodity cycles, they tend to trade in rotation. And at the moment, as everyone knows, nickel's been the hot commodity. A lot of people were looking positively for copper. That hasn't really done anything yet, and likewise silver. They're all subject to the same forces, and it's sort of decarbonisation and how it's going to affect demand for all these metals, nickel, silver, and copper going forward. But they tend to go in rotation, and silver's turn hasn't come yet. Really, I think it will.
Mm-hmm. Angelos, Ian mentioned decarbonisation there. In terms of, I guess, some of the industrial uses of silver, do you see like an increase in that in 2022 and beyond?
Yes, the industrial uses of silver have been increasing rapidly over the last few years, primarily because of the alternative energy drive in the world. As we all know that silver is extensively used in solar panels, but also in because of its superior electrical conductivity, increasingly in electronic devices, and the drive for electric mobility has increased the demand for silver. There's a lot more silver now demanded to build electric cars. So we think that this is the fundamental demand drive behind silver over the next few years, particularly as the physical supply of the metal is rather constrained. There is a significant potential to for the price to rise because of this fundamental demand. But that is in addition to the safe haven demand for silver, as silver is seen as the cousin of gold in terms of safe haven appeal. So as gold prices reach higher levels, it is historically we have observed that silver, being more volatile than gold, tends to outperform the gold price on a bull cycle run.
Does that mean, therefore, Torsten, that we can expect to see sort of like silver get higher over the course of the next 3 months? And sort of like just as gold, I think, has risen as at 9% in the first 3 months of 2022, we'll also see silver rise as well?
I think this is the first silver lightning maybe on the horizon. As Angelos pointed out, there's like this initial factor coming from the safe haven demand because of the Russia-Ukraine thing, but I think it's not the fundamental long-term picture. When you look at the data from the Silver Institute, for example, for last year, we had the market deficit, like a small market deficit, where supply is in shortfall of demand because of two factors. First is the industrial demand, and the second is the investment demand getting into silver. And this looks like this market deficit is widening up to 25 million ounces in 2020 under normal conditions. If safe haven demand is even rising, we're talking about a bigger market deficit, and market deficit always is a good factor for prices. So I expect the price to rise in terms of a gold-silver ratio dramatically over 2022.
And just as a follow-up question to that, Torsten, in your view, are there enough good silver exploration projects coming through to go and meet that demand? Is the sort of pipeline good enough?
It's always a matter of timing because of the long waiting lists on the mines. I mean, there's like 1/3 of all the mines in silver mines is primary silver mines in the world. The rest is byproduct of different base metals. Base metals have a good run, so we don't expect here a shortfall on that. But the development, brownfield and greenfield development, from the time-wise, it's catching up. Mine production for this year is expected to raise between 7–8% in total. But from our data, we think the demand is raising faster than that. So therefore, the supply demand gap is widening.
Mm-hmm. Moving on to the different ways of investing into silver. Maybe I'll pose this question to Ian first. Do you have a view on investing in silver bullion versus investing in silver mining companies versus investing in silver ETFs?
Yes, we have a view. I tend to agree with a view of both Angelos and Torsten that we're in a bull market. Whether we see that bull market develop in the next 3 months needs to be seen. But it's going to kick in at some stage. And if it does, I think there's a lot more money to be made in the mining companies than there is holding effectively the metal. The metal will always lag the mining shares in a bull market. It doesn't matter whether it's gold or silver or even base metals. You're always better off in the equities in a bull market.
Mm-hmm. And just as a follow-up question, in terms of the mining companies that you particularly then look at, is it kind of more in terms of producing silver companies, or is it more in the exploration development stage?
Well, our fund tends to buy their more established silver producing, but I think Angelus's fund is more geared maybe towards the exploration sector. So they're two subsectors of the same sector, but they have different risk-reward characteristics.
Mm-hmm. Perhaps that's sort of like nicely sort of segues into a question for Angelos. I think that certainly some of the viewers would be quite keen to know about your approach to investing into silver companies. And can you perhaps, within the context of that, explain as to how you factor in the silver price into how that plans into your investment decision approach and strategy?
Yes, well, we have always followed two main principles in our investment approach. The first one is avoid political risk, and this has evidenced itself with the horrific situation in Ukraine between Russia and Ukraine. So we decided early on in our investment operations not to touch unstable territories like Russia, former CIS countries, and other unstable regimes. Because we thought that we take significant risk in terms of the cyclicality and the volatility of the underlying commodity, not to overlay an unquantifiable risk, which is the political risk, i.e. the risk of direct expropriation or war risk as it happens now. The second principle is that we always focus on resources in the ground. We like to see a lot of resource in the ground, which gives us confidence that there is the fundamental value of metal in the ground that should rise if we are right about our prediction of the commodity price. Mm-hmm. So even if the company does nothing, hopefully if the deposit is sound and economically viable, it will gain in value as we move along the cycle. Mm-hmm. But of course, beyond those two principles, there are many filters that we apply in selecting investments. The most important, of course, being the management quality. People are very important in managing companies and bringing mines to production. So unless you have competent management team that not only has experience in developing mines, but has particular experience in the area of operation of that particular company. So, and beyond that, one has to look at the balance sheet strength, the financial strength of the company, its ability to finance its projects, and importantly, its ability to raise capital in the capital markets. And that falls back to the credibility of the management team, as well as the quality of the asset. So these are the key criteria that we follow. And as Ian pointed out earlier, we do focus on earlier stage situations, not necessarily grassroots exploration. As I said, we like to see some resource so we can hang our valuation on. But importantly, we like projects that have a very short timeline to production. So development stage projects where there is a reasonable chance of raising the financing to build the mine or grow the production capability, but in a fairly short period of time, so that we can capitalize on an early cash flow from a mining operation.
Mm-hmm. Would there be anything you'd like to add to that, Torsten, in terms of your investment strategy?
Yeah, I think to add on that, it's also a question about the preference of the investors, of course. When I'm looking at our two funds, the SSC mining fund and the Angel Mountain Precious Metal Fund, one is more like a natural resources focused fund, which has gold and silver besides the other resources and natural resources stocks, and the Angel Mountain precious metal is like 40% invested in the silver companies throughout the different stages. But we also have investors who like directly have a bullion exposure, because I totally agree, in the bull market, of course, the mining companies are outperforming bullion by far, from historical measures with a beta factor of like 2.5, approximately 2.5, 2.7. So it's immense in terms of reward. But bullion, of course, either in form of a physical or in form of an ETF, gives you another point of security. So some investors, like with a big discretionary mandates with us, are having like gold bullion and silver bullion in their portfolio as part of our alternative strategy. And then other kind of investors are going more on the equity side. And if you would like to emphasize besides the stage, I mean, the smaller and more risky the business model gets, the higher the potential reward on the upside. So I think the key parameter here is like a balanced approach, or like how do you balance the risk profile here?
Sure. We've talked a bit about sort of like risks, sort of like profile, both sort of like political risk and also other sort of forms of risk as well. I'm just interested here. This is a question for like any like one of you. How do you manage jurisdictional risk when you are looking at companies? Because there's like risks in terms of permitting, there's indigenous nations risks, and how do you get comfortable with those jurisdictions? Because sometimes it must be a very clear-cut jurisdiction like Russia, where it's unsafe, and you've probably been uneasy about investing in Russia for the last like 10 years or so. But sometimes there are those jurisdictions which are slightly like borderline. How do you sort of like assess whether it's either a red light, as in don't invest, or green light and do invest? I don't know which one of you would like to answer that.
Well, I'll look at that. Europe also allow for that. This is a constantly moving beast. I mean, what's viewed as a risky jurisdiction today might not be viewed as a risky one tomorrow, vice versa. We tend, in our fund, because we've probably got the highest silver exposure in any precious metal fund around. I mean, our exposure to silver mining is probably 60-65% of the total. But in terms of jurisdictional risk, 87% of the shares we own are Canadian domiciled companies. Now, that doesn't mean all the mines are in Canada, but it means all the corporate governance and everything else is in Canada. And within that, there's obviously a lot of exposure to Mexico, there's obviously a lot of exposure to Latin America. But the underlying companies that nearly all the fund is invested in is in Toronto Stock Exchange.
Mm-hmm.
Mm-hmm. Yeah, I think the exchange. Oh, sorry, Angela.
No, after you, Torsten, please.
Oh, thank you very much. I was just thinking about two countries in terms of this approach. When like on the gold or like on the natural resources side, the DRC and Bolivia on the silver side, like 30 years ago. When of course you have also the drawdown risk on the Canadians when they got expropriated from the asset side from the head of government. But I totally agree on the fact that jurisdiction risk definitely is not time stable. Russia for a couple of years ago, I would consider it like not a very high risk in terms of jurisdiction. When you look at the majors on the oil side and some other companies doing business there, and business was quite good. So it's can change quite rapidly. And the same, I think, is true for some Latin American and African countries as well. So it's very hard to have like an overall strategic fit to that question from at least talking from our investment approach. What we do is with, for example, data from Fraser and other institutes to balance out, like, for example, asset quality and grades versus the geography. And then we put, for example, like the one mine, like one company, one mine shops versus like 2 or 3 mines, so like a bit of diversification on the asset base that can balance out some risks in terms of that. So that means to put it on the ground, like a mine in a small Latin American company with high grades might equal in terms of investment attractive, all else the same, with a lower grade asset in a more safe jurisdiction, just to on the plain side.
I'd like to add a couple of things here that, of course, jurisdictional risk exists even in the so-called, the perceived safest jurisdictions, even in North America, British Columbia, or some of the Canadian provinces, where the permitting risk becomes a quasi-political risk or jurisdictional risk, if you like. So, and the same holds true for some American states. For example, Idaho has been notorious of being extremely difficult to permit new mines. But as long as there is clear visibility that the permitting issues can be addressed, this is a much easier risk to quantify in the valuation of a potential project or a company. As Torsten Dennin pointed out earlier, jurisdictional risk does change, and we have seen a significant change in the political risk in Latin America, for example, recently. Peru, for example, has changed its government recently to a more left-leaning government that has sort of made some moves or noises so far, has not made any direct legislative moves to penalize miners in Peru, but they have suggested that they are looking at various options of increasing taxation or royalties, or perhaps the hurdles of operating in Peru. And that can cause investors temporarily to move away from these jurisdictions and cause a general de-rating of all the mining companies in this particular country. So diversification and a careful approach not to overexpose one's portfolio in a particular region or a particular country is always a sensible approach.
Mm-hmm. One area we haven't discussed so far is ESG. I think turning to yourself first, Ian. Okay, ESG has been around for, since like you and I probably first met back in 2014. It was obviously like social license to operate then. So it's always been around. But I'm curious from like Charteris' point of view, how has it changed the way that you invest over the last couple of years? Or have you always been investing via an ESG lens?
It hasn't really changed very much, to be honest. I mean, I think the thing that has changed is a lot of these mining companies, not just the big ones, but now all the medium-sized ones and the smaller ones, all have a much more increased focus on ESG. They all have ESG policies, all have ESG committees. Go back 20 years ago, the mining industry maybe didn't have a very good name with regards to environmental issues, but they've all cleaned up their act. And you also have to, there's also a part of that ESG is social. And a lot of these mining companies where they operate, very often they're the ones that fund the hospitals, they're the ones that fund the schools. But a lot of the mining companies actually do a lot more than other industries. So although mining isn't everybody's ESG cup of tea, I think the mining industry deserves a lot better reputation for ESG than it perhaps gets, to be honest.
So do you think it's more of like a mining brand image problem rather than the mining companies not doing enough?
Yeah, I think so. A lot of people think, you mentioned mining to some people, they throw their arms up in horror, polluting the local water supply and all this stuff. But I mean, I think that was more like the mining industry of sort of a few decades ago. I don't think it's representative of the mining industry today. They're a lot more all over this stuff than they used to be. As I say, a lot of these places, they fund the hospitals and the schools in the communities where they operate.
when you're looking to invest in a company, Torsten, and you're looking at silver mining companies' ESG investment criteria, how do you look to see that it's sort of like genuine and meaningful, and it's actually an ESG policy that they're actually actioning rather than just a pretty page on its prospectus or company website?
Yeah, we looked a lot on this question a couple of months ago, because we just started ESG strategy for private clients on our pension products. But this is not in regard to the silver industry, but overall in the stock market and the bond market. So therefore, we're talking about green bonds and like sustainable investment products as a kind of fund of fund. But from that knowledge, I was also coming back to the gold and silver industry, because of all the different ESG approaches here. Because of course you can have a positive list, you can have a negative list, you have 4 or 5 different approaches how to get into the ESG. And of course, when you compare like a gold or silver company with like a sports and leisure company, you will never get to the same ESG score, yeah, by nature. But for example, in the best-in-class approaches, when you look at the industry and say, look, you compare like 10 companies, and from the 10 companies, 1 or 2 companies in terms of industry doing dramatically well in terms of ESG. For example, the funding of infrastructure, the funding of schools, the funding of social projects, environmental protection, talking to the agencies and all that. When we talk to the management about these programs and how they allocate money to that, they having like a benefit in terms of not only about investor demand. From this best in class, like continental European investors are demanded to invest in ESG conform companies. So therefore, it's more and more on the capital flow, and the companies get aware of this. And there are like companies who are already leading best in class approaches, and some are falling behind, from my view.
What are the key data points that you use, Angelos, when assessing ESG? Before making a potential investment?
Well, I would echo the comments made by my fellow panelists that the mining companies are fairly good generally in meeting the S and the G, that is the social and governance aspects of ESG, because they do a lot for the community. We, at least for the type of the kind of companies that we prefer, they have first-tier management teams with very solid governance procedures and processes. The environmental aspect is always the gray area, because the mining industry is an energy-intensive industry. It requires a lot of equipment that is mobilized, moving a lot of earth, moving a lot of volumes of material that needs to be crushed and processed, etc. So it's a very energy-intensive industry, and it's very hard from the perspective of the purists of ESG to accept it as an environmentally conscious industry. So it tends to get painted with a broad brush of a so-called dirty industry. But if you look at, as Torsten suggested, at the best of breed companies, the companies that are very conscious in terms of minimizing their energy consumption, in terms of minimizing the use of chemical agents and reagents, in terms of utilizing the most efficient operations to process the ore and extract the material. These are aspects that we take into account in our investment appraisal process. So we like to follow the companies that have a very disciplined and conscious approach, not only to the social and governance aspects, but the environmental aspects, in terms of being as efficient as possible, as in a very energy-intensive industry.
Going back to the title of this panel, it's obviously looking at silver opportunities in 2022. I'm curious if each of the panelists could pick either one silver company to go and watch in 2022, or if you want to, you can kind of answer that differently and say one silver sort of jurisdiction or one silver trend to watch in 2022, if you're not allowed to comment on actual individual companies. Starting with yourself, Angelus, which sort of silver company or trend for 2022 should we be looking out for?
Well, as you say, the trend we believe is definitely positive for silver as far as the commodity is concerned, and we expect silver to move significantly higher from the current levels. Not only because of the geopolitical situations, which we think will drive the safe haven aspect of silver, but also because of the industrial demand. And so putting this into perspective, most well-managed silver companies that own an economically viable resource should do well. Now, there are a couple of jurisdictions that are particularly big producers of silver. For example, Mexico, Peru in Latin America, and then to a lesser extent, Chile and Argentina further south. These are very important silver producing regions, and these are the sort of hunting grounds to find the best quality projects and the companies that are best positioned to extract the best value from these projects. So there is a plethora of companies operating in that territory, and investors should be able to find some very attractive opportunities.
And what about, just a follow-up question, what about the US? Because I guess off the top of my head, I think the US is probably the #1 country where we've seen the biggest increase in mining corporates attending our events over the last year or so. I don't know whether you've sort of seen kind of increased interest in silver companies there?
Yes, absolutely. Particularly in Nevada, there is a number of very large developments there with pure silver-focused companies. And some of them are actually addressing historically producing mines that they are looking to bring back into production, and are drilling around the territory of the historical production to find additional reserves and resources to bring to production. Further north, there are also some new silver districts developing in British Columbia and some of the other Canadian territories. So we see significant activity for either past producing operations or for newly developed resources, newly identified resources that should be coming to the market in due course. So there's a much better selection of companies, I would say, in the last couple of years that we used to see 5 or 6 years ago in the silver space.
Mm-hmm. Ian, what's the one silver company or silver trend that you would pick?
Trend. Yeah, we should really talk about individual companies, but the trend. Obviously, we discussed all the potential uses for silver on industrial level. Like these new electric cars will have Wi-Fi in that, so the big increase use for silver in the new industries going forward, water purification, solar panels. So the trend for the price, if you're talking about the price trend, has got an upward push to it. Where silver is different maybe from nickel and copper is when it hits a bull market, its underlying volatility is off the planet. It's far more volatile than any of these. Now, we've seen nickel go from $20,000 a ton to $100,000 a ton in 2 days on the NME with its Chinese short position. And then it's come back down again, and people think, oh, the volatility is off the scale. The other factor we haven't talked about is central bank monetary policy and all the money that's been printed. That's one of the root causes of this bull market in commodities. And the last time, if we look at the 50-year cycle, the last time we had a big bull market, proper bull market in silver, it went from $1.50 an ounce in 1971. 8 years later, it was $49 an ounce, and nothing on the planet can keep pace with that volatility. So when the bull market in silver finally does arrive, it's potentially much bigger bull market than anything you've seen in any of these other metals, whether it's gold, platinum, copper, nickel, or whatever. So when its turn in the queue is, we'll have to wait and see. But if and when it gets going into what we would call a proper bull market, the upside in silver is much, much greater than probably any other metal around. It's just historically far more volatile.
Yeah. You mentioned we hadn't really touched on central bank policy. Let's just like delve in a little bit there. I mean, what are your sort of predictions for central bank policy over the course of the next sort of like 12 months? Do you see anything changing, or do you see anything changing that will actually impact silver? Or
yeah, I think that the Fed Reserve, but not only the Fed, the Bank of England, ECB, all of them just continue to spout utter rubbish. They talk tough. I mean, we had Powell yesterday saying, "Oh, I'm going to go for a 50 basis point cut next time around. I'm going to really get tough on inflation," and yet they're still continuing quantitative easing. In the last month, the Federal Reserve printed $44 billion worth of new money. Its balance sheet is just about to go over 9 trillion. So they talk tough. They put interest rates up by 25 basis points when inflation is 7%, which is a joke. And they, at the same time, they're still printing money, which is the root cause of the inflation. If they were serious about fighting inflation, they would not only not be doing any more quantitative easing, they would stop it straight away, but they'd probably move to quantitative tightening. I would buy back some of these, sell some of these bonds that they bought back. But they're not. They don't want to. They're just waiting for the base effects of the big rise you've had to iron out, so they can then claim that inflation's coming back under control. Because at the end of the day, there's so much debt in the system that they are terrified of putting interest rates up by too much. They cannot even dream of putting interest rates up anywhere near the underlying rate of inflation, which is the old Taylor rule, because the economy and the stock market would just crash. If you put rates up to 5, 6, 7%, where the rate of inflation is, the whole house of cards come tumbling down. So they're going to keep wimping out of putting rates up. They're going to continue to make excuses. They talk tough, but they don't act tough. And I think you should focus on what they do rather than what they say.
I saw Torsten, I think, like nodding his sort of like head from like Germany. I wonder if you had anything to add to that, or would there be anything that would go and challenge that hypothesis? So, for example, I think is it like November 2022? We've got the midterm elections. If suddenly the Republicans sort of like won more seats in the Senate and House of Reps, would that go and like challenge what Ian's saying, or do you think it will be just more the same, and that we'll carry on printing money?
It's reminded me on the last 2 terms I'm teaching at university, economics and finance, and trying to explain my students how the economic machine works, as Ray Dalio put it. But I was just smiling when I said, because I totally agree on the facts. Looking at the European perspective, we know that the ECB is following what the Fed is doing in terms of its cycle. But what you saw in the background of this high inflation numbers is that the excuse just changed from that perspective. It's maybe not that they don't want to do, but they are not able to do, because we are with a back against the wall on some of these perpetuum mobile about this hidden financing of governments. Because first there's like the big financial crisis, the big recession, global financial crisis. You need to do quantitative easing on that to bring the interest rate down, to flood the engine with cash that the machine keeps running. Then it was, what was coming then? The COVID crisis, the Corona crisis. You need Corona bonds. You need Corona helps in terms of a huge bailout, not only from the banks but from the whole economy. And now the excuse, at least from the European side, not to start tightening on that, is, oh, look, there's no conflict, Ukraine and Russia, and it has negative GDP impact. We need to keep the machine afloat, so we can't increase interest rates because the GDP will fall to pieces. And then, after Putin probably is stepped down or whatever happened to peace with this kind of conflict, the next thing is just around the corner, because we need to finance the green alternative energy transition. So there's basically no opportunity or no option to increase interest rates at like an historic average levels on that. So this means combined with a high inflation number, real interest rates are going to extreme negative rates, and this is a good surrounding for not only for silver but for precious metal in general. I mean, maybe you've noticed that for the whole commodity complex, the rate of backwardation is up to 5% positive. So for the first time in decades, you're making 5% by holding commodities. So that's higher than the dividend yield of the S&P 500. So therefore, the case for commodity, as Pimco said, it's quite nice. So when we look at the consolidation year in silver last year, the $15 to $18 range is gone. 22 for this year probably is the new support to the resistance to the downside. And Ian, you just put out the almost $50 in 79 and 1980. I would love to see silver go to that old levels and to make new highs. If you put this inflation adjusted, that would be my long-term vision, because I'm, from my character, more like optimistic on that. When we're talking about $60 to $120 silver, this is inflation adjusted numbers from 2011 and 1918 to today's time. Wouldn't be lovely to see the ounce at $120? I certainly think so.
Yeah. Potentially. If I may make one additional point to all the remarks, that the Ukrainian conflict has put a completely new perspective in the world order. And even if we assume that Putin backs down or something happens in the administration in Russia, and there is some kind of a peace agreement, and for some miracle, the situation in Ukraine stabilizes, the fact will remain that confidence in Russia will take many years to restore, as far as the Western world is concerned. So sanctions are likely, possibly decades. So sanctions are likely to remain very punitive against Russia for the foreseeable future. And that could cause a dramatic recession and unemployment to the Russian people, the Russian economy. And effectively that would spill over to the global GDP growth, and therefore, whilst at the same time maintaining a very strong inflation on commodities, because we all know that Russia is a very important commodities producer and exporter. So with a continued strong inflationary environment and a weak economic growth, we think that there is a very high probability of facing some kind of a stagflationary environment. And under that environment, there is no way any central banker will dare to increase interest rates, because that would further cripple the world economy and tip the world into recession. So unfortunately, the central bankers have their hands tied for the foreseeable future. Let's see how this conflict in Ukraine develops. Hopefully, it will not escalate to anything more nasty and more, potentially dangerous for the rest of the world.
Yeah, totally agree. But the last time we saw the stagflation picture unfolding in the late 70s, this is the development that pushed silver to the $50. And I mean, there's lots of impact for other asset classes. And I just keep my fingers crossed that the precious metal investors and the bullion investors have some stake in that, and like having some of their value saved for that.
Sure.
Mm-hmm. Just as one sort of like final kind of question, again, I think touching on something that Ian mentioned earlier, talking about volatility. I know this isn't particularly like a silver-related question, but obviously, as an investor, we live in quite sort of volatile times. How do you manage volatility in your investments? Maybe as Ian mentioned volatility, I should ask it to you first.
Well, I mean, we've chosen to put 65% of our funds into silver mining shares rather than 35% into gold mining shares. So we made a conscious decision to opt for get as much potential volatility into the fund as we can. Mm-hmm. So we don't want to, that's a conscious decision. Mm-hmm. Now, we've done that on the basis that the outlook for silver over the next few years is potentially extremely good. If we didn't think the outlook was very good, we would be looking to massively reduce the volatility. But we don't. I mean, volatility equals percentage gain in a bull market. And that's where we placed our bets. It's just interesting, just to recap on what the two other panelists have said. We're all in agreement that central bank policy, as it is, very constrained. Rates aren't going up. Money printing probably continues. You can't have a more bullish background for commodities than this.
Mm-hmm. Would any of our other panelists care to add anything about volatility or any final comments on central bank policy?
In talking about volatility, lots of investors who are in the precious metal consider the precious metal like as the safe haven and the low volatility play on that. It's including the silver mines, because the other alternative they have on the alternative investment scheme, like when you want to bypass the monetary system and the economic system, is the crypto scene. And when you compare crypto volatility to silver volatility, you can sleep quite good with the silver investment.
Well, I think
yes,
that
I would also say that it depends on the appetite of a particular investor in terms of their portfolio positioning. Obviously, looking at the silver market exposure per se, some investors might choose to have some bullion exposure, which is obviously much more solid and much more stable in terms of volatility than mining equities. But within the mining equities, they might look at one segment having the producing companies, which have a very solid balance sheet and a cash flow, a solid cash flow generating position, and then another segment of the portfolio into the earlier stage or development stage companies that are the growth part of the industry, and therefore can be even more volatile than the other two elements. So it depends how each investor allocates their exposure within their portfolio and what's their appetite for volatility as to what type of product they use to identify or capture this volatility.
Well,
Andrew, could I just make one further point? Is that the silver at $25 an ounce, the volatility is asymmetric. It has a potential to go up several times its current price, but it hasn't got the potential to go down to a fraction of its current price.
I mean, certainly just to round off this sort of panel and to try to end the panel on a positive note, I've been now with Mines and Money for 2014, and certainly 2014 was a fairly gloomy time to join Mines and Money and join the mining industry. But certainly things are, very, very bullish in terms of like commodities as a whole. And I think that silver is definitely going to look very, very strong for not just 2022, but 2022 and beyond. And we can only hope that some of the geopolitical situation obviously sort of irons itself out and resolves itself. But even if that happens, silver will still be a very, very strong commodity bet. I think that brings us out of our time. So once again, I'd like to thank our panelists, who were Angelos Damaskos, Chief Executive Officer of Sector Investment Managers, Ian Williams, Chairman and Chief Executive Officer of Charteris Treasury Portfolio Managers, and Professor Dr. Torsten Dennin, Chief Investment Officer and Member of the Management Board of Asset Management Switzerland. And this was Andrew Thake from Mines and Money. Thank you very much.